Good morning, everyone. Welcome to the Quad Cities Chamber of Commerce webinar. Certainly picked a great day for a webinar with the weather as it is. So today's webinar is how your company benefits from the Employee Retention Tax Credit. Derek Pillars of Honkamp is going to tell us more about this credit. Angela White with Honkamp is also joining along. I'm Kerry Smith, VP of Finance for the Quad Cities Chamber. Appreciate you joining us today. Before we begin, a couple remarks. I think you'll be surprised to learn how many organizations of all types and all sizes are eligible for these tax credits, and how large the total amount of dollars an eligible organization will receive. Again, both large and small companies qualify. Really important to note that suspension of operations is not a requirement to be eligible. I will point you to the testimonials that are included in the slideshow. Derek's not going to read them, but please take your time. The materials are provided to you, and you'll see that even small businesses are receiving very large refunds. In one case, one of the testimonials has a $450,000 refund. During the webinar, we will take questions throughout. Please type in your questions in the Q&A box. We'll answer as many as we can. The webinar will be recorded and available on the Chamber's blog and on the website. So with that, I'm going to introduce today's speaker, Derek. Derek, take it away.
Thanks, Kerry. This is Derek Pillars. I'm tax manager at Honkamp here in Davenport, Iowa. Been with Honkamp since the beginning of 2018, when before that I was with Gableman and Associates and we were acquired. Also joined today by Angela White, who is also a shareholder here at Honkamp. We've been, here in our Davenport office, we've been the ones that have been leading the charge here on the ERC, Employee Retention Credit, trying to get the word out here to people here in our community that survived the pandemic, and hopefully being on the back end of it now, we can take a look back and see what we can do with various government programs that came out here in the last 3 years. So that's what my life has been here for the last 3 years. I've taken a lot of time on the ERC. My hope today is for you that are unfamiliar with it, to give you some insight on what exactly it is and what to look for. And for those of you that are somewhat familiar with it, and you've talked to your CPAs about it, maybe give you a little bit more to think about. So that's the purpose here today, and we'll just start right in. There's two ways that you can qualify for the ERC in both 2020 and 2021, but the rules for each year are a little bit different. One of two ways. The wages that you pay in a calendar quarter in which your business operations were fully or partially suspended due to a government order, which limited commerce, travel, or group meetings. Or in 2020, if your business had a more than 50% decline in gross receipts in 2020 as compared to the same quarter in 2019. And you would qualify for every quarter after that until you're in 2020, until your gross receipts exceed 80% of what they were of the same quarter of the prior year. For employers with more than 100 employees, the ERC is only available to those who paid wages to employees who did not work. So example of that, if you're a large employer, have more than 100 full-time employees, and you say, hey, because of the government shutdown and everything like that, we don't have work for you to do, but we don't want you looking for work elsewhere, so we'll continue to pay you until this blows over, and then you can come back, and you can only take the ERC on those wages. But for the majority of us that I think are here today with 100 or fewer full-time employees, all the wages that you pay, if you meet one of these two criteria, could qualify for the ERC. So that's 2020. The main difference that you need to look at is this this 20% or 50% of gross receipts. So in 2021, if your business was suspended by a government order, then you qualify between those dates of the government order. But in 2021, it's a little bit easier to hit if your business had only a 20% decline in gross receipts in any calendar quarter in 2021 compared to the same quarter in 2019. So it's a 2-year look back. Okay. Then you would qualify under the gross receipts method. So it's either or. You don't have to meet both. And we'll go into this a little bit detail a little bit later, but if you don't qualify under the gross receipts test in 2021 because you say, well, in Q1 we didn't have a 20% decline, you can actually go back and look at the prior quarter, and if you met it there, then that'll qualify you for the quarter that you're looking at. Then this for employers with 500 or more employees instead of 100. Wages that qualify are those that you pay to employees not to work. But employers with less than 500 in 2021, all the wages can potentially qualify. So you'll see as we go along here that the 2021 credit is a lot sweeter than it was in 2020. But you'll also find that these operations that were suspended due to government order kind of dried up in 2021. So we're really looking at the gross receipts method here for 2021. So how do we calculate it? For 2020, that's March 13th to December 31st of 2020. When March 13th is when the national disaster was declared. The ERC is up to 50% of up to 10,000 of wages, so you can get up to $5,000 per employee for 2020. Like I said, it's a little bit sweeter here in 2021, and it's only for quarters 1 through 3. You can get 70% of up to 10,000 of qualified wages per quarter, so that's 7,000 per employee. So yeah, if the employer qualifies for the ERC in 3 quarters in 2021, it could be 21,000 per employee. If an employer qualifies for the ERC from March 13th to December 31st, you get the 5,000 for 2020 and 21,000 for 2021. The credit is worth up to 26,000 per employee, theoretically, and that's what a lot of these folks, you're hearing on NPR and everywhere else advertise. You can get up to 26,000 per employee, but recognize that in order to do that, you'd have to be under either a government shutdown or have a gross receipts decline between March 13th of 2020 and September 30th of 2021. But the thing is, this credit adds up really quick because, I mean, when you look at it, if you just look at 2020 alone, if you have 10 employees that you paid $10,000 to in a year, then you're getting $50,000 credit, for just those 10 employees. You have 20 employees, it's going to be 100,000 just for that. And then 2021 is even better because it's $10,000 per quarter, and that's where we see the refunds just pile up on these. So one thing I do want to mention, the wages used to, because a lot of folks went out and got the PPP loan, at least in 2020, and maybe half of that amount went out and got them for 2022. The wages that you use to claim forgiveness for that may not be used for the ERC. But what we can do is, if you have a lot of employees who earn over 10,000 per quarter in 2021 or 10,000 per year in 2020, is we can apply those PPP loan forgiveness wages to those that are after the 10,000. So then we have the 10,000 to work with to take the ERC on. So don't let that discourage you. Yeah, that's out there, and yeah, it does limit the credit, but there's ways to work around it. We'll get into this a little bit. I know, a lot of us, don't have the worry about the 100 or 500 employee, full-time employee calculation, but here it is. It's same applies for 2020 as 2021. What you do is you add up, you can get there one or two ways. if an employee had an average of at least 30 hours per week or 100 or has 130 hours per month, then they are considered a full-time employee. You can do it either way. Then you just tally those up for each month of the year of 2019, pre-pandemic. Then, if you have less than 100 of those employees, then, you don't have to worry about, whether or not you paid employees to stay home or not. I mean, then all wages could theoretically qualify. Then you take, you take that and you do that calculation for every month and divide it by 12. And if you're under 100, then all wages qualify for 2020. If you're under 500, all wages could potentially qualify for 2021. Now we get into, do all wages qualify for the ERC? No. But do owner spouses wages qualify as employees for the ERC? Well, yes, provided that the owner is not a person who owns directly or indirectly more than 50% of the value of the corporation's stock or partnership capital and profits. This also includes indirect ownership of with family members. So we're talking, if you have a business and then employ your son, granddaughter, this goes aunts and uncles, in-laws, everybody basically except for cousins, then, and you're more than a 50% owner in the business, then none of those wages qualify. But we want to point out that the rule is more than 50%. So if you own more than 50%, then those wages won't qualify. But if you own 50% with another unrelated party, then your wages do qualify. And, I think of two examples here. A hair salon was an S corporation, owned 50-50 by two gals. They're not related, so their wages qualify. Small software engineering firm, owned by three guys. They don't have any employees, but three unrelated guys, all their wages qualify. So that's how owners' wages would qualify. But if you're a sole owner in your business, then you or your family members' wages won't qualify. Control groups. I want to stop right here and say I'm going to give you a very simple example today. If it goes any deeper than this, I encourage you to reach out to Angela or myself, and we can gather all the facts and to see if this does apply to you. But I'm gonna give you one simple example here today of how this works. Say you you're a construction contractor and you have an S corporation, you're sole owner of that, you have employees, you had a good year and you weren't subject to a government restriction, but you also own 75% of a restaurant. And the restaurant was shut down in Iowa, and the Iowa shutdown dates, I believe, were from March 17th of 2020 to February 6th of 2021. And then on the side, you also sell vitamin supplements. So, okay, you own 100% of your business as a contractor, and then you own 75% of a restaurant, and then you have your vitamin supplements that you sell. You own more than 50% of all of them. So you have to combine your gross receipts of all three businesses to see if you qualify under the gross receipts method. However, if your restaurant qualifies under the government shutdown and your restaurant constitutes more than a nominal portion of the three entities, and we'll get to what that means here in a second, then that would qualify all three businesses for the employee retention. Well, only the two, because you probably don't have an employee selling the supplements for you, but that could potentially qualify your construction company. But you also have to recognize that the 100 full-time employee calculation comes into play. So if you have more than 100 in 2020 or 500 in 2021, then you'd have to limit the credit to employees you paid not to work. But so that helps in the realm of the government shutdown. You might be able to qualify a business that you own completely that normally wouldn't qualify. But if you have if you have three unrelated businesses that weren't subject to a government shutdown, you need to combine all the gross receipts, and a lot of times that might kick out a business that could have qualified on its own. So there's two sides of it. It's just something we need to look at. And if you own certain business, if you own a certain percentage of a business, and family members own certain percentages of other businesses or anything like that, give us a call, because that requires some analysis to see if we need to aggregate or not. What is fully or partially suspended? Businesses fully or partially suspended due to government orders from federal or state government limiting commerce, travel, or group meetings due to COVID occurs if an appropriate government authority imposes restrictions on the business that the business must cease operations, or the business can continue to operate with some but not all of its normal operations. So you can have a partial shutdown and qualify for the ERC, but you have whatever part of the business that was shut down has to constitute more than a nominal portion of your total business operations in that entity. So what is more than nominal? Business that was fully or partially suspended due to orders from federal or state government limiting commerce, travel, or group meetings due to COVID-19 occurs if that portion of the business that was shut down, if that constituted more or not less than 10% of the gross receipts of the total business during the same period in 2019 that you're under the shutdown, then that constitutes a government shutdown that can qualify all wages for that business for that year. If that doesn't work, you can also look at the total number of hours worked in that service line compared to total hours worked in 2019 during that shutdown period. Same period during 2019, pre-pandemic, and if that constituted more than not less than 10%, then that business is considered more than nominal, and that could qualify your whole business under a government shutdown during that period. I want to take a minute here with this, with the order from an appropriate government authority. And how it reads in the IRS Notice 21-20 is that they are orders, proclamations, or decrees from the federal government or a state or local government limiting commerce, travel, or group meetings due to COVID-19. In our work that we've done so far, and we've done a lot of work, and then in our conversations with fellow CPAs and AICPA America, we haven't found a federal government order which rose to the level of a government order which qualified any business for a shutdown. I mean, there's CDC recommendations out there, there's OSHA recommendations, but they weren't federal orders. So what we've been relying on are mostly state government orders and city and county government orders, which are specific on what they do allow and what they did not allow during the pandemic period. So examples that the IRS gave us was of what they include are, an order from a city's mayor stating that all non-essential businesses must close, and emergency proclamation that residents must shelter in place, except for essential businesses, which is exactly what we had over in Illinois. An order imposing a curfew on residents that impacts the hours of operation. So say, I know that, there are some places that were required to close 2 hours early during the pandemic period. So that would qualify as a government shutdown, but just a recommendation from the CDC or OSHA, we stay away from that. I mean, we've read through those, and we don't believe that we have a basis for those. So when you're talking to people, just kind of watch for that. That's what I'm saying. So let's put a real world application to it. I chose this one because it's similar to the situation we had in Iowa in 2020. We have a restaurant. It offers indoor dining services in addition to outdoor sit down and carry out service. So the outdoor sit down and carry out services are permitted by the government order. They weren't shut down, but indoor dining had to space tables 6 feet apart. And during the same period in 2019, the indoor dining constituted more than 10% of their gross receipts. So because this constituted more than 10% of the gross receipts, the spacing constraint had more than a nominal effect on the business operations. So the employer's business operations are considered to be partially suspended by government order. In Iowa, that was during an 11-month period between March and February. That restaurants and bars and establishments like that were considered to be partially shut down because of a government order. And what it's not, I used a big example here. Just say you have a grocery store, primarily selling groceries, but they also have, self-service offerings such as a salad bar and everything like that. They closed down the salad bar, and salad bar isn't 10% of what they do, either, gross receipts or hours wise in 2019. That's less than a nominal. So that grocery store would not qualify. So that's where the gray area is. It's in these government orders that we really need to look at. We need to examine the state and the city and the county government orders, which will tell us whether or not a particular business would qualify. The gross receipts, you can get there one or two ways. Either the government shutdown, like I talked about, but if you don't get there that way, you can try with the gross receipts method. And what are gross receipts when determining whether you qualify for the ERC? It's everything you can think of that are normally gross receipts. Your sales less your returns and allowances plus any investment income or rent or anything like that. And one thing too, I mean, if you have a capital intensive business, say you sell a service van or something like that. If you still have a basis that you hadn't fully depreciated in it yet, you only have to pay tax on, or I'm sorry, you only have to include in gross receipts the amount of gain that you would have had when you sold it. So everything that you think of when you're preparing your tax return, which is gross income, that's what we have to look at. So we're looking at a decline. Like I said earlier, it's calculated a little bit differently for 2020 and 2021, a little harder to get to in 2020. Your gross receipts have to decline by at least 50% of what they were for the same quarter in 2019. So, if in quarter two of 2019, you had 200,000 of gross receipts, quarter two of 2020, you only had 99,000, you qualify. And you qualify up until the end of the quarter where your gross receipts exceed 80%. So the takeaway from that is if you qualify for one quarter, then that automatically qualifies you for at least one other quarter in 2020. And you'll see that that's true in 2021 too, but there's a different way to get there. In 21, it's a little bit easier to get to the gross receipts decline. If your gross receipts decline by at least 20%, when compared to 2019, so it's a 2-year look back, then you'd qualify for the ERC. If you don't qualify, if you're looking at, quarter one, you say, shoot, we didn't decline by more than 20%, but I guess we're out of luck. Not exactly, because you can look back at a prior quarter, and if you declined in that quarter, then you would qualify for the quarter that you're looking at. And this is easier to explain with a couple examples here. So say you're looking at your first quarter of 2021, you're looking at your gross receipts and you say, well, we didn't decline by 20%. I guess we're out of luck, right? No, not exactly, because you can look back at quarter four of 2020 and compare that to quarter four of 2019. And if you hit the 20% decline, then you would qualify for quarter one. So you're looking back. So here's the tricky part. You're looking back at quarter four of 2020, which is the quarter right prior, versus quarter four of 19. So that's a 1-year look back when you're looking at quarter one only. Quarter two and quarter three, say you're looking at quarter two and you say, shoot, we didn't decline by 20% when compared to the same quarter in 2019. You can look back to quarter one of 2021 and compare that to quarter one of 2019. And if you qualified, this is the 2-year look back, then then you can go ahead and take the credit on ERC on quarter 2. Same thing with quarter 3. You look and say, nope, we didn't qualify, but you can look back at quarter 2, and if you qualify in quarter 2, then you automatically qualify in quarter 3. So you can still get if you qualify for one quarter under the gross receipts method, you can qualify for the next quarter for 2020 and 2021. There's just a couple of different ways to get there. Here's another example of that. And when we send out the this PowerPoint to you, you can take a look at this, but basically explains it the same way, just in a different format in case you want to look at it a different way. So I mean, that's pretty much the ERC in a nutshell. That's you know, everything that we need to look at, you know, in you know, the standard situations. You know, are you under a government order? If you say no, then you look at your gross receipts and you say, well, did we qualify, you know, because we had a decline in gross receipts. And here are a couple of examples of some special situations that applies to some people. You know, say you started in 2019, you don't have any gross receipts to go back and look at for, you know, say you started in quarter 3 of 2019. Well, what they tell you is you can take your quarter 3 2019 gross receipts and use that as your base for quarter 2, you know, when you're comparing your 2020 and 2021 gross receipts to that. You know, same thing. If, you know, you start in quarter 4, you can take your quarter 4, use that for of 19, and then you can take your quarter 4 of 19 gross receipts and use that as your base for quarter 2 and quarter 3 of 2019 to compare to 2020 and 2021. And if you start in the middle of the quarter, they do allow you to prorate and then move that back. And this one I want to point out for a lot of our small businesses that started after February 15th of 2020. You have gross receipts of less than $1 million, and you know, immediately I think, okay, you know, a coffee shop. You know, you open up a coffee shop after February 15th of 2020, employ a couple of baristas. You're not going to make anywhere near $1 million in your first year. You don't have to meet the gross receipts or the government order test. Instead, what they say is you automatically qualify no matter what for quarter 3 and quarter 4 of 2021. So these are the only group of people that can take it for quarter 4 of 2021, but it's capped at $50,000 per quarter. You can't have more. You can't take more of a credit than that. Then the next one here that's in there, but I haven't seen, and I haven't talked to anybody who has seen it. You know, if you're a large employer, you have more than 500 employees, and you had a greater than 90% decline in gross receipts as compared to 19. You don't have to pay employees not to work; they'll just let you have it. So that's the one I want you to look at. If you started after February 15th of 2020 and you have annual gross receipts of less than $1 million, you know, I hope you take away from this that you do qualify automatically for quarter 3 and quarter 4 of 2021. You just can't take more than $50 per quarter. And that is